Here's a recent trade I just finished. A huge 10% gain and massive profit, helping out my portfolio so much. How did I know this chart was about to go up? Because of this candlestick pattern right here. And in this video, I'm going to share my favorite candlestick patterns, just like this one, that I use on a daily basis. That way, you can read and understand chart patterns, predict chart direction, become a more successful trader, and make plays just like this one. Let's get straight to it, shall we? One of my favorite and most used candlestick patterns I like to trade with is the engulfing candle. I've used it in many of my previous videos. It's such a strong candlestick because it can give you the exact point of when a reversal is about to happen. What is an engulfing candlestick? Well, it basically explains itself in the name. It's a candlestick in the opposite color of the previous candle, and it simply engulfs it. A bullish engulfing candle opens at or is lower than the previous candle's close and closes above the previous candle's open. So basically being bigger than the previous candle on both sides, making it look as if it's engulfing it. Let me show you an example. So here we found a pretty strong support where price bounced off it multiple times, telling us it really respects it. We see the price comes back down to the support. We can expect it to bounce back up, but before entering, we need a little more confirmation rather than just assuming the support will hold. That's when we see a bullish engulfing candle. It completely engulfs the previous red candle and is exactly at the support. This is an extremely bullish sign, and we can be pretty confident the price will go up from here. So we enter the trade and look what happens. Now, it's also important to note that just because there is a bullish or bearish engulfing candle doesn't mean the price is going to reverse in that direction every time. You shouldn't be just trading purely off candlestick patterns. You should be using them as almost if they were hints on which way the market is about to go, not pure decision makers. You should be using other tools with candlestick patterns, like support and resistances, indicators, different strategies, etc. So just to be clear, just because you see a bullish engulfing candle doesn't mean the price will go up from there, but it can be a good indicator that the price will head in that direction. Let me show you a bearish example. So here we have the same type of setup, a strong resistance where the price respected it multiple times before, and we see the price comes back up and starts to slow down, giving us a bearish engulfing candle, completely engulfing the previous green candle. We see that it got rejected at the resistance and there was a bearish engulfing candle, indicating this is a good sign to go short. And look what happens. Price goes down. Next, we have the momentum candle. The momentum candle is a lot easier to spot than the engulfing candle, purely because of its size. A momentum candle is simply a candle that is 2 to 3 times bigger than the previous candles before it. This candle can be insanely powerful because most of the time, after it happens, the price will continue to go in that direction, making this point a great time to enter. The most efficient and effective way to use this candlestick pattern is in choppy markets, where the price is moving sideways. If you ever see a sideways market, then a huge momentum candlestick appears, being 2 to 3 times bigger than the previous candles, you can be pretty certain that the price will continue in that direction. Why is that? Well, think of it like this. Whenever there is a sideways market like this, there are a lot of shorters stuck in their trades. They don't want to exit their trade yet because the price is moving sideways and it can honestly still move in either direction. They draw their support and resistance and set their stop losses right above the support. So that means there are going to be tons of traders setting stop losses all over this area. Meaning, if there's a sudden price movement and price hits this liquidation zone, all these stop losses will be hit, just adding fuel to the fire for this price to keep moving up. Also, when price breaks a choppy market like this, it'll usually start a trend in that direction. It's the same type of strategy with shorts. If there's a choppy sideways market and you see a huge red candle 2 to 3 times bigger than the candles before it, this is a great indicator to enter a short position because it's likely the price will continue to move downwards. Next, we have the multiple candlestick pattern. This is one of my favorites as it usually holds pretty true on charts, and it's also pretty simple. All it is when you have 3 or more candles that have wicks going one direction. The more candles, the better. I like to pair this candlestick pattern with support and resistances. So look at this chart. What do you see happening? Well, for one, we have a key support where price bounces off multiple times. Then we have multiple candles candles with wicks going downwards, exactly at the support. As you can see, all these candles have downward wicks, telling us that sellers are trying to break this support, but buyers keep fighting them off and are winning multiple times, confirming that this is a key support and price has a good chance of bouncing upwards. As said before, the more candles, the better the probability the price will respect that pattern. Let's go over a short example. Price moved to the resistance. There are multiple candles with wicks heading upwards, telling us that price really doesn't want to move up from here, giving us a good short entry. So we enter here expecting price to reverse from this point, and look what happens, it does. Next we have the doji candle. The doji candle is a candlestick with a very thin body and it has wicks on each side. Why this one is so important to understand is because it can be a great indicator on when the price is about to reverse in a direction. What this candle basically represents is the market is uncertain on which way it wants to go and is having resistance. Whenever there is uncertainty or resistance, the price will more often than not head in the opposite direction. Let's see an example. So here we have price moving down pretty hard. Then a green candle appears and it just so happens to be a doji candle. This is telling us that sellers are starting to be less confident and buyers are starting to enter, making this point a great potential place to enter. What I normally like to do with doji candles is after I see one, I'll wait for 2 or more candles the same color to confirm that the price will reverse. So in this example, I see a green doji candle. I wait, see 2 more green candles heading upwards, telling me I can be confident that the price will continue in that direction. So this is the point where I enter the trade and boom, the price goes up from here. There are multiple different variations of the doji candle that you might see. There is the regular one, which is the one that we just talked about in the last example, the long-legged doji candle, which is basically the same candle but just has larger wicks, the dragonfly, which has a small body and a big bottom wick, then the gravestone, which has a small body and has a big upper wick. All of these tell the same exact story, a reversal in price. The next candlestick we'll be looking at is the hammer. The hammer is usually a candle that looks like this, a decent sized body and a long wick. What this candle is telling us is that sellers got the price all the way down to here, but the buyers absorbed all that selling pressure and raised the price all the way back up. This is usually an extremely bullish sign and can tell us that the market will continue to go in that direction. A candlestick that is very similar to the hammer is the shooting star. The shooting star is just like the hammer, but it has a small wick on the opposite side. You should be playing this just like the hammer, where if you see a shooting star candle like this, you can have a good suspicion that the price will start reversing. This next candlestick pattern is called the tweezer. This pattern is a red candlestick followed by a green candlestick, both having similar wicks on the bottom. If you see this pair, you can have a pretty good idea this chart is about to move upwards. Let's see an example. So here we can see price is about to hit this support. We see a red candle with a wick on the bottom, right at the support. Then we see a green candle that also has a wick heading downwards. This is telling us that the price is respecting this support and is now gaining some momentum upwards. This would be a great time to buy. And look what happens, price raises. It's the exact opposite for a bearish signal. So you want to see a green candlestick, then a red, both having wicks at the top. We see that exact pattern here, and boom, price falls. The last and final candlestick pattern I want to talk about is the Maribozu. The bullish Maribozu is going to be a big green candle without any wicks, so basically just a big green rectangle. The cool thing about this pattern is that it's a good indicator that price will keep heading in the same direction it's going. You will usually see this candle in the middle of a trend, confirming that the trend will keep moving upwards. Let's see an example. So here we saw a price reversal. Price is starting to head upwards, then we see a bullish Maribozu candle. Notice how the candle has no upper or lower wicks. This means that the lowest price of this candle was the exact same as its opening price, and the highest point of this candle is the exact same as its closing price. This is telling us that buyers have complete control, and we can almost certainly predict that price will continue to go upwards. And look what happens, it does. does. The bearish Maribozu is the same idea, a red candle with no wicks. Here we see the price had a reversal, we see a bearish Maribozu candle telling us sellers have control and the price will probably keep moving downwards. We enter, making this a winning trade. Now it's time to give you a bonus tip for all of those who made it to the end of the video. This is a way of me saying thanks for watching all the way to the end. Even though you should probably try to memorize these patterns, so when you see them, you can have an idea of what the market is going to do in the back of your head, I completely understand that it's hard sometimes to look for them or even remember what they look like. Well, lucky for you, there is a way to make it so you can have your chart tell you exactly where a certain type of candlestick pattern occurs, which makes it really easy for you to spot them, and you don't even necessarily have to memorize them. To do this, just go to TradingView, click the Indicators tab, type in whatever candlestick pattern you want. So for this example, we'll do a bullish engulfing. Simply click it, and TradingView will notify you on the chart when the bullish engulfing candle appears, making it extremely easy to spot when it happens, and you don't even have to look that hard. You can also add multiple candlestick patterns to your chart so you can identify when any of them occur. I hope you guys got some value out of this and you learned something new. If you did, I would really appreciate it if you took 5 seconds out of your day and liked this video.
Let's go ahead and jump right in. So secret number one is kind of a two-parter. So let's go ahead with the first part now. When we're trading candlestick patterns, I want to explain what we're actually looking for. A lot of trading educators will draw out a trend like this. And sure, that is an uptrend, but that's not normally what price looks like, right? What price normally looks like is something more like this. We have price pushing up, then we have some consolidation, maybe another impulsive move, and then finally we keep pushing higher and higher. So when we're doing this, when we're in a trending market, there's gonna be two things we're looking for trading our candlestick patterns. Those are going to be extreme highs and extreme lows. You can also call these major swing highs and major swing lows. Doesn't matter what you call them, but let me point them out for you. In a counter trend perspective, when we're looking to go against the trend, which is one way that I trade personally, and it tends to work out pretty well for me, it is favorable if you do it correctly. When we're going counter trend though, what we're looking for is the extreme highs in a uptrend to look for our candlestick pattern as that extreme high. So if price is continuing to push higher, breaking into new highs, we want to wait for a candlestick pattern at the very top of that new high. And what this is doing when we're waiting for new highs and a candlestick pattern is it's giving us the best opportunity to capture this pullback where we can make profit. So if we're placing trades at that brand new high, stop loss above it, just in case price does push up, we just get stopped out, no big deal, and a target that gives us a favorable reward to risk ratio, looking for this pullback from the top of our trend. And we're doing that over and over when we are counter trend trading with candlestick patterns. Now on the trend continuation side of an uptrend, we'd be looking for the bottom of the pullback, and we'd be looking for possible candlestick patterns at the bottom of the pullback in order to capture the next impulsive move higher. So we're just looking for the bottom of this pullback to have some type of candlestick pattern right here at the bottom of it as the swing low of the pullback in order to capture a move higher out of price in an uptrend. And in a downtrend, it would be exactly the opposite. I'll give you an example of that right now. This is what that would look like in a downtrend. We would have prices pushing lower, continuing lower, continuing lower. And what we're looking for counter trend trades in a downtrend is to capture the very bottom of this trend so we can capture some profit on this pullback. The very bottom of the trend, the very bottom of the trend, all these new lows would be considered the major swing low in this downtrend. Next up, for trend continuation, we're trying to capture the very top of a pullback with a candlestick pattern in order to capture the next impulsive move down that breaks below our structure level. So we're looking for the tops of these pullbacks to give us a candlestick pattern. And obviously, there's no strategy that's 100%. You will get faked out at times in trend continuation and in counter trend trading, but this is what we're trying to do with candlestick patterns. Now, part number two of secret number one is going to be to have rules for your candlestick pattern. You don't need to be second guessing if something is the exact candlestick pattern you're looking for. If you're trading hammers, you need exact rules for hammers. If you're trading shooting stars, you need exact rules. If you're trading engulfings, you get the point, right? So what I want to do right now is share with you my rules, my set in stone specific rules for hammer and shooting star candles, because that is the candlestick pattern we'll be discussing most in this video. Let's take a look. On the screen in front of you, you can see a hammer and a shooting star candle. And the way I define these in order to keep myself consistent and never second guess whether I'm actually seeing a hammer or a shooting star candle is by utilizing a Fibonacci retracement tool. So I take my Fibonacci retracement tool from the low of the candlestick up to the high of the candlestick, and as long as the entire body of the candlestick is above the 38.2% retracement, which is my little blue line here, then I have what I consider a valid hammer candle. And it's the opposite for a shooting star candle. For a shooting star candle, I'm looking from the high of the candle down to the low of the candle, and as long as the entire body of the candle is in fact below the 38.2% retracement, then I count that as a shooting star candle. So hopefully that gives you some more clarity on what I mean by having set in stone rules for the candlestick pattern you're using. That way you can stay consistent and you're never second guessing whether or not the candlestick pattern you're trying to use is actually there on the chart. Secret number 2 is never trade candlestick patterns without at least 2 other major technical confluences. Now on the chart, if you want to screenshot this, you can, is my list of major technical confluences that I use in combination with candlesticks. Let me do a brief explanation really fast to explain things a little bit further. So earlier we talked about looking for possible counter trend trades at the top of the move that's in trend, right? We were talking about this level, and this level. Well, if you're doing this in the middle of nowhere with no other confluences, then it's not a profitable way to trade. The only thing that makes candlestick patterns at major swing highs profitable is adding other confluences. My personal confluences, things like major structure levels. A higher time frame major structure level would be even better. What I normally count as a major structure level is a level that's either been tested multiple times or a level that sticks out like a sore thumb. So in this case, this would be a major structure level that would help me make the decision to place this trade. Another major confluence that I use is the RSI indicator being overbought, oversold. As you can see, divergence is even better. So if I have this at a major structure level and I have divergence from here to here, as in prices are going higher, but the RSI indicator is going lower instead of higher, as prices make higher highs, RSI makes lower highs, that would be an example of a divergence. So if I have divergence and prices coming to a major structure level, that is when I can trade a candlestick pattern. But I must have 2 other major technical confluences before I can trade candlestick patterns. And or another confluence that I have is the cross or bounce of an EMA. So I like to use the 50 EMA. Let's pretend this is it. What I would need to see is price cross the EMA, then pull back to the 50 EMA in order to look for some type of candlestick pattern to follow the trend to the downside after this reversal of crossing the EMA, or at least possible reversal. Now to clear this up even further, I actually have 2 live trades I'm in right now on a live account. You can see that looking down here on my Onda live account that are currently in profit, thankfully, and we're going to take a look at the analysis behind them because it lines up with exactly what I've been teaching you today. I used exactly what you're learning in order to get involved in both of these trades. So first off, what are we looking for? What did we discuss earlier? We want to see the lows in a downtrend create some type of candlestick pattern. But that's not all we look for, because if that's all you look for, you will not be right more than you're wrong. You won't have a profitable strategy. We need to add some confluence to it. So the confluence I used on this specific trade consisted of 2 parts. Firstly, we do in fact have a major level of structure that sticks out like a sore thumb here on the Canada Swiss. And also outside of that major level of structure, if we pull up our RSI indicator, you'll see that we do in fact have RSI divergence. As prices are making lower lows here, the RSI has started to make higher lows. With that being the case, this is a great example of RSI divergence combined with a major structure level. And then this specific trade was not utilizing a hammer candle, but it did in fact utilize a bullish engulfing bar right here. And that's when we got involved in this trade directly after that bullish engulfing bar. Hopefully that gives you a little more clarity of this situation. I have a bearish trade I'm in also on the pound dollar utilizing the other confluences that we've already discussed. Let's take a look at that trade now. Here's that live trade. We actually placed this trade last night and we're up somewhere around $2,223 at the moment looking for profits. Hopefully we see this market continue pushing down, but can you spot the confluence I used on this trade and the entry pattern based on what you've learned in this video? So hopefully you were able to spot this entry pattern, because if we zoom in a bit, you'll see that this candle in fact meets the rules for a shooting star candle for the way I trade them. The entire body of this candle is below the 38.2% retracement. Also, what is the confluence that we have? So we also have the cross of the 50 EMA, that's my blue line, and although we didn't quite come up and touch it, I do count this, because of how close we got, as a bounce off of the 50 EMA. So we have a cross and a bounce off the 50 EMA, and with both of those occurring, I count that as two major technical factors, and with that, decided to go short on the close of that shooting star candle. So to close out secret number 2, never trade candlestick patterns without at least 2 other major technical factors in confluence with that candlestick pattern. Again, these are the confluences that I use. If you'd like to screenshot them and use them yourself, go ahead and do so. Secret number 3 is the technique I adopted most recently. I've been trading candlestick patterns this way for about the last 5 years, and it has by far become my favorite way to trade candlestick patterns. And that is by adding candlestick patterns to existing chart patterns. And if you'll look with me right above my face, right above the video, you can see that number 4 on my confluence list is existing chart patterns. So what I mean by that is head and shoulders and inverted head and shoulder patterns, along with double tops and double bottoms. Let me give you an example of a bullish trade where I would use this in combination with a candlestick pattern to actually place a trade. So right here on the dollar Swiss, we can see price coming down. And there's normally 2 different ways that a lot of traders will be trading things like a double bottom. One way would be an aggressive way where you wait for the first bottom, then the second bottom, and you just place the trade when you see price push a bit higher after that second bottom. That would be a more aggressive way to trade a double bottom. A more conservative trader may decide to wait for the break of the neckline of this double top. That would be a more conservative approach to trading this double bottom. But using a candlestick pattern, we can kind of meet somewhere in between, where it's a little bit of a more aggressive way of trading, but not as aggressive as just waiting on a double bottom. Let me explain what I mean. What we'll be waiting on when using candlestick patterns in association with existing chart patterns like double bottoms is for this double bottom to appear, and to also, at the end of the double bottom, give us some type of candlestick pattern. So let's actually push the market forward and see if we get that in this specific scenario. So right there, that's not a candlestick pattern we're interested in trading for the bullish direction. But next up, we get what? We get a candlestick pattern. This specifically is an engulfing pattern. So right here, we have a valid double bottom followed by a candlestick pattern being this engulfing pattern. So the exact way I trade using this type of setup is I wait for a scenario that meets my list of confluences. Remember, I have to have at least 2 confluences. Well, we know that we have the double bottom. So we have number 4 checked off. We have an existing chart pattern. So one way I could trade this is if I had an existing chart pattern alongside a major level of structure right here, and then after that existing chart pattern, obviously, I got my candlestick pattern. Another way is I could use the RSI divergence method, which is what we're doing on this trade scenario. So if we look down at the RSI indicator, you can see we have a low right here, which is a low in price. We then get what? We get a lower low in price while the RSI indicator is making higher lows. So that is what we call RSI divergence. So in this case, we have an existing chart pattern combined with RSI overbought oversold divergence, and we have our candlestick pattern. So this again is by far my favorite way to utilize candlestick patterns, is by combining them with existing chart patterns. And in this case, the way I would set up this trade would be something like an entry on the close of that engulfing candle or whatever candlestick pattern you choose to use. A stop loss below the double bottom. For me, I like between a 1.4 and a 2-to-1 reward to risk ratio. We'll go with 1.4 for now. In this trade, I already know what it does. It happens to win. But obviously, every trade doesn't win. Before we talk about that, though, let me go ahead and take you through a bearish example of this so you have a complete understanding of it right now. Hopefully this one is pretty easy for you to spot, but here we have a head and shoulders pattern followed by a candlestick pattern. See if you can point that out while I draw it out for you. So we have first our push higher, our shoulder of the head and shoulders pattern, our neckline, the head of the head and shoulders pattern, followed by the other part of the neckline here, and what we have pushing up here at the second shoulder is a nice shooting star candle. Right here would be that shooting star candle. So for this specific pattern, what I'm looking for is this head and shoulders. And at the end of the head and shoulders pattern, I want to see a candlestick pattern like this shooting star candle. The trade setup would look something like this with an entry at the close of that candle, a stop loss just above it, and again, about a 1.4 to 1 reward to risk ratio is what I personally like to shoot for with these trades. And if I click play, although every trade won't win, you'll see that this specific trade also worked out in our favor. So understanding candlestick patterns and these three techniques of how to trade them and applying them will improve your trading. But trading comes down to a lot more than just understanding candlestick patterns. And that is why I'm currently looking for 500 new or struggling traders to mentor throughout the remainder of this year. Throughout this mentor process, you'll get access